Hello, I'm certified financial planner and enrolled agent Chris Cooper, and talking today about tax planning for your 2020 tax year. Many of you are now just trying to finish your taxes for last year and may even have till July 15th of this year to do so. But many of you need to do some planning for this year because planning takes place during January to December, not after the year ends and you start preparing your tax return. The biggest one that I see people needing to plan for is changing their withholdings. Now, many people say, I haven't changed anything and yet I'm owing. What's happening? Well, during the latter part of 2018, the government changed the withholding tables and started taking less money out of your checks. That way it made you look like you had more money coming in or supposedly having a tax break. But in reality, all it was doing was reducing the amount of withholding tax you had. So your actual refunds, if you had any, were reduced considerably. So if you didn't change them for 2019, many of you are owing money and owing it big time. So how do you change your withholdings? First, you go to your employer and get the form called the W-4 form. It's also on the irs.gov website, which you go to and you take that form and you will make that out, and it's very different than it was in the past. We don't count the number of dependents we have, things like that anymore. So you actually have to go through and use what they call a calculator, and it's on the website there, and it helps you to make them out. Now, with six-figure incomes in double income couples, I find the biggest mistake they make is not using the single withholding amounts. Instead, they're marking the married box on the W-4 form. And this is where you'll see this on the form here. So first thing is consider always using single and not married if you're in a double income couple. Second thing is to consider how much tax do you need to have withheld. And how do you know that? Will come from your previous year's tax return. So this either will be your 2019 tax return, or for some people, if you want to know why you are owing, you look at your 2018 tax return and you actually see the line that says the total tax. And on 2019's tax return, you see that on line 12B. It's on the second page of the form, and that number tells you right there how much tax you need to have withheld during this year or paid in what we call estimated tax payments, or a combination of both. That way you get that money withheld so that if you owe more money than that, you will not have a withholding or an estimated tax penalty. A penalty is a wasted amount of money, it's not deductible, and it could actually add up to significant amounts of money depending on how much you owe. So you want to always use what we call the safe harbor method. Make sure you withhold the amount of tax that's equal, and in this case to line 12B from your 2019 1040 tax return. The second area to look at now is consider also that you may need to change and withhold your state tax differently. So if you live in one of the 41 states that have a state tax, or the District of Columbia, which also has a income tax as well, you may need to adjust the withholding that's done on that one as well. But they have their own forms, and each state is unique. So you will need to go and look at your state's form as well to see if you need to change the withholding. The last thing to look at is many of you will not have deductions that you're used to having because they were done away with after the 2017 tax year. Those included things such as union dues, safety deposit box rental, professional license fees like for a professional engineer or a registered nurse or somebody like that, your continuing education, travel for business meetings, investment management fees, gambling losses, and moving expenses, except for people that are in the military, are now no longer deductible. But the one that people really don't realize is tax preparation is no longer deductible. So whether you pay a professional to do your taxes or you use one of the tax software services like H&R Block's Tax Act or TurboTax or one of those fees are now no longer deductible. So these are some things to think about when you're doing your planning as a person who has a W-2. Now, many of you, though, are also doing second things called the gig economy. You might be a Lyft or Uber driver. You might be getting self-employment income from other various sources. You might even be working for a former employer as an independent contractor, doing a job that you used to do for them as an employee, or you're doing a different job altogether, something that they didn't have you doing before. With the gig economy person, self-employed people, otherwise known as independent contractors, also known as gig workers, also known as self-employed. It does mean you are self-employed. You're not an employee of someone else. This means you have the responsibility of paying in both the employer and employee's portions of the Social Security and Medicare tax. This is probably the tax that will cause you to owe money when you file your federal tax return, more often than income tax. So you need to estimate your self-employment tax, which is equal to 15.3% of your net profit from your self-employment after you take out your expenses, such as car mileage, phones use, equipment rentals, supplies, and other things that are related to your business. So the biggest mistake I find is not estimating your taxes correctly, not paying them in either through withholding on your regular job with your W-2 form, or not paying in estimated taxes. This will always get you in a penalty, and this is one of those things where the penalty could be avoided if you simply do a little planning. Think about that. And also, the bigger thing I find with the gig economy worker is they're not setting any money aside in case things don't happen. So for a lot of gig economy people, they're not working right now. They don't have the opportunities. That's why they were included in the CARES Act for unemployment benefits. And also, many of them will also have a mistake of not setting aside money for their own retirement. Retirement plans can help reduce income taxes, but not necessarily the self-employment tax. So these are just some simple things that I think you need to consider when doing your tax planning for the 2020 tax year.